Hello traders, Gary Wagner here. Just about 12:40 in Honolulu, 6:40 in New York. It is Friday. Happy Aloha Friday, as we say on the island. First day of November 2019, and this is the daily report for gold and silver, our weekend review. And what a week we have seen. We had the markets, especially gold, with very little change throughout the beginning of the week, the better part of last week, and things took off on Thursday when we got our first pop above $1,500 per ounce. It then closed roughly at about $1,503, and then we had that surge yesterday up $17, followed by today's fractional gain. We'll take a look at that when we have our price board. Really, what is on the minds of traders is the spin about the trade war and the potential resolution or the stalemate, because from day to day we're hearing different news that they are going to meet and sign something. Yesterday, the president of Chile actually came out and said the conference was canceled. So depending on the news source you're listening to, you're looking at a couple of different worlds. And I guess the truth will come out in the end. But for now, I think it's extremely, extremely bullish for gold. We did enter a long position yesterday. We'll talk about our entry, our stop, as well as our target on the top when we look at some charts. We certainly saw gold break out of its sideways trading range this week when it effectively closed above $1,500, really for the first time in a couple of weeks. We had a surge yesterday. Today, a fractional gain you can see on the board, plus $1.90. We're currently at $1,516.70. We are long from $1,514. When we pull up our charts, I'll talk to you about the different targets we have for the upside, as well as the rationale behind why we moved our stop where we did. Now, the other precious metals actually did better. Platinum futures up 2.25% at 954 and change. Silver up about 0.25%, back above $18 at 1811. And palladium continues to rock the world, $1,780.80 after applying a $25 gain on the day. Let's take a look at our charts. We will look at two charts on today's show, a weekly candlestick as well as a daily. The first is the weekly, and what jumps right out at me is the range of the week was fairly expanded. We had a large range. However, the differential between where it opened, which is the bottom of the green rectangle, to the close is rather narrow. It is doji-esque because the body size is so small. You could almost call this an inverted hammer. And the only reason I'm not giving it that identification is typically one of the first criteria is it should be a pretty sharp and defined downtrend before you get this candle to look at it as a key reversal. That being said, we hit a couple of really important benchmarks as we move to higher pricing this week, but to see them, let's take a look at a daily chart. When we look at our daily chart, we can see two things that are absolutely significant and point to a high probability of a rally that is beginning. The first thing is, you notice we've been looking at this compression triangle, and on the triangle we have defined the upper level resistance line from a series of lower highs using this high here, as well as this top here. Now, we did have one point last week that opened above and closed at, but then moved back below throughout the week. But then Thursday, we had that tremendous upside move. A couple of weeks back, we identified a compression triangle. It is a simple pattern in which you're getting a series of lower highs, forming your resistance trend line, as well as a series of higher lows, creating a support trend line. We can see that for the most part, since, call it the middle of September, we hit the top and we would simply oscillate between the top and the bottom of this channel. Then, mid-October, we changed that because we went relatively flat until last week when we had this sharp spike up I called it a false breakout. That's a week ago Friday. What we were looking at was the market moving to a high of 1520 and actually closing at about 1503. Monday and Tuesday, we saw a decline. And then on Wednesday, we had the first positive move to the upside. But as you can see, the high stalled right at the top of the resistance line. All of that changed yesterday because yesterday we opened at the resistance line, we closed well above it, and besides doing that, we effectively once again broke above the 50-day moving average. Now, as you're well aware of, the 50-day moving average is one of the most important tools that analysts use to determine if we are in a short or long-term trend. If it is above the 50-day moving average, that means a very, very short-term prognosis is bullish. So I am looking for higher pricing. We put on a trade yesterday. We got in at 15.14. We placed our stop a little bit below this line, and I actually looked to give us some protection around here, and we put it at 14.68. Now, we will look to move that up relatively quickly, but the key traders is the fact that it maintains a price point above this critical level of support that was former resistance. And traders, lastly, I do want to look at a variation of the candlestick chart called a Heikin Ashi or a Japanese average. The difference between the two is how they peg the open. You have a true open on a candlestick chart, and on a Heikin Ashi chart, the open is always derived from the midpoint of the prior candle. What that tends to do is give us A, an indication of trend, and B, most importantly, an indication of strength of trend, so that when we have these solid upside candles, large body size, strong trend, when we get sideways action, that can be easily identified as an oscillating pattern of color with smaller bodies. You can see here we have a nice defined uptrend, a defined downtrend, and when we look at current pricing, we can see that we had somewhat of an oscillation. It wasn't every other candle, but here we got 4 red candles, 1 green, 2 red, and then 3 green, 1 doji, 2 reds, and now we're at 2 green candles after the breakout. The other thing that is significant is that over the last 2 days, there's been no lower wick, and that simply tells us that at no point during the trading session did prices go to or below the midpoint of the prior candle. Maintain your current long position. Maintain your stop. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.